Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. Good to see you.
Nice to see you as well. So thanks again for doing this for the road, giving us this hour. I appreciate your time. I want to talk about something I don't think you and I have ever talked about. So about 3 or 4 weeks ago, the dollar was on par with the euro, right? So, hey, if you want to travel to Europe, this is the summer to do it. What we saw on Friday, again, topic number one was the Fed being clear. Rates are going higher. Rates are staying longer. The dollar has reascended and now setting even higher highs. But I know there's two things to be true. The strong dollar is going to hurt two things for sure and may hurt others. First, there are emerging markets like Sri Lanka who have dollar-denominated debt that are going to be in real trouble. Second, international companies who sell goods around the world in foreign currencies that have to convert back to the dollar are going to be hurt because it'll be less because the dollar is so strong. So I have a sneaky suspicion one of the things not being talked about there is just how strong the dollar gets and how much pain that could cause around the world. What do you think?
Yeah, it's a big issue with trade, and like you said, other governments that have their debt denominated in dollars. We already saw earnings last round. A couple of companies that had some losses and didn't meet guidance because of the dollar strength.
Microsoft called it out, for example.
Yeah, for that very reason. So, being a globalized economy like we are, as globally connected as we are, which is why I'm a global macro investor. Even though I invest in the United States only, I don't invest abroad, emerging markets. That's just not my thing. I still watch it because it affects everything we do here. The global recession, so there's big energy issues, abroad in Europe especially. The dollar is an issue for emerging markets and other countries, like you said. And there's a domino of some of these countries that, like Sri Lanka, that are lined up behind them. Venezuela, just go on and on and on.
Yeah.
That as the dollar rises, as energy goes up, as food becomes more of an issue due to the war in Ukraine and other issues. It's a very fragile environment out there, and as goes the world, as goes the economy of the United States.
Yeah, that's what I'm looking at now. And again, this is not something that will like roll up on our doorstep tomorrow, but it's out there.
It's not going to tank us either, or anything like that. Like, if the world start, these smaller emerging markets start collapsing, it's not going to kill us, but it's going to affect trade. It's going to affect the ability to get things, and it's going to affect things in general. But
it could affect liquidity, right? Which may, again, that's something that we've been talking about for a while. Like, again, I think QT rising, quantitative tightening versus quantitative easing, I think it kicks in more in September. It gets up to the next tier of activity. I'm actually watching the strong dollar. It did spike again on Friday, and it's continued to spike this morning. Again, it's not something that I think shows up on our shores tomorrow, but it could be one of those nasty surprises if we get into a recession. Again, housing's in a depression, economy's in a recession. Europe's clearly in a recession. We have more emerging markets show pain. You just can't help everybody if all of this comes at the same time, which I think is a risk for next year.
Well, it's just a global reckoning. So we've been on a QE, easy money,
the world has
liquidity path globally since 2008-9, and we should have let things unwind back then and naturally reoccur and reset the economy back then. It didn't happen. So now we're facing that fine line of almost an inevitable choice of having to reset the global economy and avoid collapse of global economies around the world. But I think we're at a point now where we can't kick the can down the road anymore. I think it's come home to roost. And what's really interesting is the monetary theorists out there, the cases are really being tested. We've seen Japan, what their path looks like and how and how that's affected them. So it's a very interesting time. And all of this is, this whole conversation is about wealth preservation, right? You want to have capital available for when things do reset so you can take advantage of opportunities. And now is not the time. I mean, a lot of people are saying, oh, everything's on sale, I'm going to load up and this and that. This isn't the time. We haven't gotten there yet.
Not yet.
Yeah. We're not in the all clear. When inflation peaks and starts coming back down, when the Fed says we're done, we don't need to raise anymore, we're good
when
here.
They pause.
And when they can actually start unloading the balance sheet without tanking the economy, then you can say, okay, we've got the all clear, and we can look for that base, and we can start looking for better times ahead. But this is a super bubble in all assets everywhere around the world that it needs to unwind at some point. You've got to have a rebalancing at some
Yeah,
point. It's the natural business cycle. It's just a
agreed.
business cycle.
Yeah, I don't know if you saw it, but Ray Dalio over the weekend was quoted talking about given the Fed's, again, Ray Dalio basically saying, given the Fed's clear message on Friday, he fears that the stock market has a 20 to 25% downside from Friday's close. Basically repricing assets back to like risk assets and earnings. And he's talking about the strong dollar. Obviously, Ray Dalio is a worldwide investor. He's got capital everywhere. He's like, the strong dollar is it's gonna hurt some. The strong dollar feels good if you want to be if you're a U.S. consumer going out, but it hurts a lot of the rest of the world.
Yeah, it's really funny how last week, Monday, Tuesday, potentially people were talking about retesting all-time highs.
Yes, exactly.
Now they're all talking about another 20% down.
That's with Powell's 8-minute speech. That's all it took, 8 minutes.
Well, and again, that's the credibility of the Fed. That's what's on the line. That's what's been on the line. The markets were like, dude, you're not serious. You're not a serious individual. That's what that rally was all about. It was telling the Fed, you people have no clue.
You're a joke.
And you're not serious.
Yeah.
Right. And, so Powell, he has to stand up because his legacy is on the line. But more importantly than that, the American consumer is on the line. If they don't do something, again, you're going to see people marching in the streets. When you can't feed your kids and you can't put a roof over their heads because it just, wages aren't keeping up with everything else, that's when people take to the streets. And you don't want that. We're seeing it in Sri Lanka. We're seeing it in, Venezuela. We're seeing it in Argentina. I mean, you're seeing it in these countries around the world where that's what's going on because they cannot feed their families and they can't keep a roof over their head. And, he does not want to be known as the absolute biggest buffoon the Fed has ever seen. And that's the path he was on.
Yeah. Again, and I want to call it out. I think we're going to find out September 21st, 3 short weeks away. Because I think if Powell delivers anything but 75 basis points, the market's going to just laugh. It's going to be like, see, we knew it. He's a clown. He's a jokester. He talks tough, but he's weak. I think he has to deliver 75.
I don't know about that. The inflation print's going to be the guide. So if inflation is down, well, then, they can easily, they don't have to go 75.
So let's play with it. So again, I think the inflation print was 8.3 last time, I think. So
8.5.
Yeah, 8.5, 8.3, something like that. So let's talk about what down means. So again, this is an important conversation, folks, because let's remember last time headline came down, core did not. Core did not move. I want people to watch this. We're getting a lot of talking heads talk about peak inflation and all of these things. Folks, gas is down like 78 days in a row. That's headline. Core did not move. So what I want to kind of put out there, let's say headline comes down to 7.5, which I don't think anybody's calling for, but let's just get wacky with it. But core doesn't move. Again, he has to go 75. I don't think this is about headline. I think it's about core. What do you think?
Well, I think they should. So just to be clear, I think they should do another 75.
Okay.
And then if you want to hold or back off, from there, if the data, indicates, but they said we're going to be data dependent.
Yeah.
So until we see those reports, it's hard to say what they're going to do. If it's a better than expected report, in either core or headline, whatever, I think they might go 50 because you do have a couple of Fed members saying even last week, that 50 is still a hike. That's still a lot. They're saying, hey, we've hiked a lot from where we came from, and 50 is even still substantial. But most of them said, 75 is definitely realistic and doable. But they're saying 50 is not off the table. So
I don't think we should. I'm not even sure when Volcker was in. I actually should go look this up. I don't think we've ever had 3 meetings of 75 in a row. I have to look that up. I don't even think Volcker.
I don't know.
I don't know.
Yeah, it's hard to say, but
Volcker raised rates more than any other Fed, but I don't think he ever did 3 quarters 3 times in a row. He did intermeeting, he did weekends, but I don't think he did 3 quarters in a row. I should go look that up. I'm going to go look that up.
So that's going to be the conversation for the next 2 weeks is the 50-75. What do they do? What do they do? And until we get the inflation, we don't know because they're data dependent.
They are. But let's talk about Friday. We're going to get that number this week before you and I talk next week. I think there's a jobs number. I think expectations is like 238 or 250. I think there's a good chance we surprise to the upside and get like 400. Again, I think good news is bad news. I think we pull a 400. We see wages go up, 1% or 2. It's just going to be like, nope, there goes 75. Because again, you got to hit the job market. The one thing he's pointing at is the job market, right? If we get a strong jobs number, I don't even care if headline comes down. We get a strong jobs number Friday, he's got to do 75, in my opinion.
Yeah, I mean, that gives him more of a basis and a reasoning to do that. And I think the market can start expecting it. And I think they're already starting to price in that. They haven't done it yet, but I think the markets are in the process. I don't know where the Dow is, but it opened down, 300 this morning.
Let's check.
Yeah. So, the markets are in the process of trying to get ahead of that. And, we've got some fireworks coming up. And September's, the last couple of times the Fed was on this path, September, October, November, were not good months.
We're not good months. Exactly. It's one of my buddies who's a stock guy on Sundays. He actually did the research since 1948. September is actually the worst month, historically speaking, for the stock market. So buckle up, folks. We're heading into September.
It has been for Bitcoin too. There's only been 3 or 4 up months in September in Bitcoin's history, and they were all in the early, first 3 or 4 years.
I did not know that. Mr. Greg Dickerson, where can people find you?
Yep, gregdickerson.com. Go check it out.
Thanks, buddy.